Hey everybody, it's Brian Castle. Welcome to today's Market Explained. So today we have a very special episode, and we are in the midst of our FourStar Summer Conference, where we bring advisors down to a resort with a whole bunch of investment sponsors, so we can learn about all the new programs that are out there, new investments. We have tax mitigation, alternatives, different mutual funds, different apps to help service clients. So all those sponsors showed up. So we're going to do a smattering of interviews with certain of the key sponsors that are down here. So stay tuned. We're going to have 5 to 7 minute interviews with, I think, about 7, maybe 8 sponsors. And I think it's going to be a really nice episode. So stay tuned, and it will start shortly. Hey, everybody. We're doing our series talking to sponsors. We're here at the FourStar Conference, the summer conference down in Akumal, which is south of Playa del Carmen and Riviera Maya, Mexico. And one of our great sponsors is with us today, and this is Eric Boorom. Eric, welcome to the podcast and today's Market Explained.
Awesome, Brian. Thank you. Love being here.
Glad to have you. And Eric represents one of the top sponsors here. It's Worth Capital. And tell us what Worth Capital does.
Yeah, Brian, if you think about where the overall population is here in the U.S., we're really in the baby boomer phase of retirement, right? So there's about 75 million baby boomers. And out of that 75 million, they own about 40+% of the middle market companies that are privately held. Yeah. And over the next 10 or 15 years, as they enter retirement, they're going to be looking to transact on those businesses. Maybe they go to family members, or maybe they get sold to third parties like Worth Capital. So for the last 15 years, we've been buying middle market privately held businesses from entrepreneurs, typically baby boomers, with a focus on manufacturing, distribution, and business services throughout North America. So today we own several businesses in the U.S. and we have one business in Canada. Mm-hmm. And it's been great. We deal with a lot of great people. We have several hundreds of employees, thousands of customers, and we're very focused on the business that we buy. After we buy it, how to improve the business and grow the business. And eventually, of course, we do exit and sell those businesses, typically to a strategic buyer.
Okay. Now they're industrial style businesses, right? You do lighting and other things?
Yeah. So we have a sports lighting company.
Okay.
So if you've ever been to a Top Golf and played, for instance, you've been underneath our game changer lights from Fall Light.
Lights forgot Top Golf.
Yes.
Great. Everybody knows Top Golf.
Yeah, everybody knows Top Golf. We do all the Top Golfs worldwide. And then colleges and communities, park and rec, so high schools, we've got about 8,000 installations globally, been in business since the mid 80s.
Wow.
And we do manufacture those in Hillsdale, Michigan. We're a Buy American Act compliant, which is a big deal with all the tariff conversation going on and all the increased costs of import from Pacific Rim with other technologies. So we've got that business. We also have a plumbing distribution business with 6 locations in primarily eastern half of the United States. And we've got about 17,000 SKUs, different product categories, of course. And we have a fairly large e-commerce presence, that business. We have a metal fabrication business we own up in Tillsonburg, Ontario, kind of outside of Toronto. They've been in business since the mid-50s. And we do a lot of very large weldments for primarily the rail industry and material handling and scissor lifts and sky lifts, those kind of things.
Okay. Wow. That's great. So then you've put together a partnership that investors can invest in, right?
Correct.
So good. Yeah. So what's like the minimum investment?
Yeah. Minimum investment's $50,000.
$50,000.
It's accredited investors only.
Okay.
And we do quarterly reporting on that. We pay distributions periodically based on cash flow. And if we don't have a use for capital of the business, we push it back out. Yeah. I think we paid something in like 46 out of 54 quarters in our history, which is really good. And it's a K-1 tax return. So it's real equity ownership, real businesses. And you come in at the parent company level of Worth, and all of our businesses that we buy are underneath that umbrella.
Right. Nice. Well, good. Yeah. So this is available through your FourStar advisors.
100%.
Right.
Yes.
And so talk to your advisor about this and see whether this is the right thing for you. But we do have a lot of investors with Worth, and things seem to be going very well.
Yeah, we appreciate you guys. Thank you.
Great. Well, thank you. Thanks for being with us today, Eric.
Thanks.
Appreciate it.
Thanks
a lot. Hey, everybody, we're back with another great sponsor to show all of our investors. We have Matt in City, and Matt is with Hamilton Point Investments, and they're a multifamily investment company. Matt, tell us a little bit about Hamilton Point.
Yeah, appreciate it, Brian. The opportunity to be here. It's a great location with great people.
Thank you.
Yeah, we founded in 2009 and are kind of best known in the industry for our multifamily offerings, a series of funds. We're now in our 14th fund. We've also had a couple of 1031 eligible deals in the past too. So for a total of 22 offerings, all fairly similar in size and economics.
Very good.
And, we take what the market gives us and we perform very well for our investors. So it's
Great. So people need a place to live, right? And there's better places and worse places, and you guys are upgrading and building new, right? Are you buying older projects too, or?
Yeah. So we've done a couple different iterations of this. So we've,
Okay.
our first funds were born kind of out of the financial crisis. So they were distressed asset funds. We saw an opportunity there, which we certainly know now. It's come to fruition. Then we transitioned to Brian, your point, to more of a value add approach where we are kind of making exterior, interior renovations and doing, heavy value add and light value add. And now we're focused more on buying new builds from
Okay.
builders and developers who are selling into a very different environment than then they started building. So there's been a different kind of thesis, pivot, if you will, with each of our offerings.
Great. So I hope they can hear us. We have some wild people at the pool here. We're at the Secrets Akumal down here in Akumal, Mexico, and the pool's right over there. So hopefully you can hear what we're saying. But well, that's great. So then multifamily is really one of the most stable real estate categories, wouldn't you say?
Absolutely.
Yeah.
I would certainly, as you mentioned earlier, it's necessity based. People need a place to live. It's also the lower cost alternative to the only other alternative, which is owning a home. And that story is well documented as far as mortgage rates and down payments, and just obviously the cost associated with the home, maintenance, et cetera. So, we appreciate the, slight capital expenditures, especially for new builds.
Mhm.
People typically like the flexibility. Obviously, folks that are just starting families, et cetera, do prefer to rent. Just as a natural progression. So there's a lot of reasons to like it. And that's what we focus.
So then as part of a portfolio, we could add Hamilton Point as one of a great component of a multifamily portfolio or an overall real estate portfolio, right?
Yeah.
Good. And now your program, Hamilton Point, is available on the FourStar platform, right?
Correct. Yes.
Right. And so we're excited for that. And so anyway, every investor who's interested can certainly consult their financial advisor and then look at the Hamilton Point program. And Matt, we're so glad you could join us today.
Appreciate the opportunity.
Appreciate it. Thank you very
Brian.
much. Thanks for
Yeah.
being here.
Of course.
All right. Hey, welcome back, everybody. We have another one of our great sponsors here with us today. And this is Stewart Martin, and Stu is with Orion. Now, Orion isn't really an investment. Orion is a platform that has investments on it and also reporting and a whole series of other services to help advisors service their clients, right?
That's correct, Brian. Orion, we are the largest financial technology provider to the independent registered investment advisor space. We manage roughly over 5 trillion in assets.
Nice. And so like a client would get a report from their advisor, would have all their investments on it. And it's different than the client statement. It has a lot more information and analytics and performance and everything else, which is really a hallmark original of Orion. So we use all these reports pretty regularly. So everybody in our client base at FourStar knows Orion. You don't even know you know it, right? Because you're getting the reports. But also Orion, because you have this platform and have all this information, you also offer like a communities program of different managers. You offer custom indexing. Tell us a little bit about these programs.
Sure. So communities, we have over 100 independent managers on our program where you can access these third-party managers through FourStar and Orion Technologies to be able to access really the best in breed in third-party managers.
Nice. And then what about custom indexing? You mentioned that in a meeting the other day. Tell us a little bit about that.
Sure. My role at Orion, I'm a specialist in Orion Direct Indexing, and Orion Direct Indexing is essentially an index recreated in a separately managed account, and it's designed to provide tax efficiency for investors. So our whole goal is to help clients keep more of their dollars in their portfolio each year.
So then one feature of the custom indexing is, there are certain stocks that are down, but they all don't go up, right? So then you can harvest those losses and you can use those against other gains that you have. So it's very, very tax efficient. Is that right?
That's correct, Brian. So one of the key features of a direct index is the ability to tax loss harvest individual stocks. And this is a feature that does not exist within an ETF or mutual fund structure. So it is a key advantage in the direct index product.
Great. And we at FourStar, wanting to service clients better and better, have adopted this platform because it gives us so many unique services and managers and different advantages than many of the financial advisors that are out there that don't have these kinds of services. So we're proud to be users and original users. We were one of the first 200 firms on Orion back in 2014. So I know the CEO and former CEO and all those folks. So we're pretty proud to be with Orion. So, well, Stewart, this has been great discussion. Thanks for being with us today. Well, for our little interview series, we appreciate you joining us. Thanks so much. Okay, here we are back with FourStar at Secret Soccer Mall. And we have another great sponsor with us today. We have Garrett Vanhal. And Garrett's with a group called Bitwise. So that has to do with Bitcoin. And a lot of investors have looked at Bitcoin, and there's a lot of talk all about Bitcoin. Garrett, what's going on with Bitcoin?
It's been the talk of the town. I'm sure a lot of clients at home have seen a lot of pieces on the internet, on TV lately. So the recent administration has been more friendly than the previous one regarding digital assets. And we think it's turning in from headwinds to tailwinds, and about to pass some stable coin legislation coming up here shortly, ideally. And I think it's just the beginning now.
So Bitcoin's just come on the market like a storm. And I remember I was at this very resort in 2017 when it was only about $9,000 a unit. And now what's it, 100? What?
Yeah, 104, I think.
$104 a unit. So it's gone up 100-fold. And then we heard some interesting facts this morning that 90% of the Bitcoin that's ever going to be made has already been made.
Yeah, closer to 95.
95, okay.
Yeah.
But they're going to keep making little bits of it for another 150 years.
Yeah, so right now the Bitcoin miners are adding 450-ish Bitcoin to the market every single day for the next 2.5-ish years. Then they'll make 225 Bitcoin a day for 4 years. They'll be cut in half again, 112-ish a day for 4 years, until that very last Bitcoin is mined.
Okay.
Estimated year 2140 to 2150. So
they're going to end up at 21 million units, right?
21 is the hard cap. Yeah.
Okay. So why is there a cap? Is this because like currencies like the dollar and other currencies, they just keep printing money? So instead, this is a stable coin, if you will?
Yeah, so there's only going to be 21 million, and that's exactly the thesis of it, as governments over the last decade, 2 decades, have added a lot of money to the world. In 2008, 2009, the financial crisis, after COVID, people are starting to realize that $100 5 years ago is only worth about $75 today.
That's
so
right.
having that hard cap has kind of been a store of value per se, and as more people are, I guess, waking up to the devaluing of the dollar, things like the crypto industry, more specifically Bitcoin, has been finding a home for dollars.
So this is why people would buy gold too, right? So gold, like Bitcoin's the new gold?
Yes, in the sense, more digital. I think there's a place for both as an investment, but that is a very similar investment thesis.
Right.
Where people aren't whittling gold, buying goods and services. And today, you can buy some things with Bitcoin, but not in the masses. So that could happen, but we're seeing it more of a store of value investment, just like gold.
But it's the same thing. They're only mining about 2 to 3% more gold every year. So gold is relatively stable. The amount of gold that's out there is relatively stable, just like the Bitcoin. And that's why people are buying them, because you never know what's going to happen with the currency.
Right. You never know. We don't necessarily believe it as much as a currency. It could become it one day.
Yeah.
So, it's not made to do worldwide transactions like you need for a currency, but we're still early. This was launched in 2009. So we're still pretty in the early days here.
Well, and they were saying in the early days, it's not really a currency unless you had it in your pocket and use it to buy things, just like dollars or whatever. But we don't do that with gold either. So, it doesn't have to be necessarily something we spend money on, at the grocery store or whatever, right?
I think that's exactly right.
Right. But certainly it's a storehouse of value, and it's a hedge against, governments, the Mexican government did it, the Chinese government, all these governments just keep printing money, and the value of their currency is terrible.
Yeah.
And so, this is a way that investors can hedge against the profligate nature of politicians and have a stable investment that isn't going to lose its value.
Absolutely.
Right. So how do we access this? So you can buy units of Bitcoin, but you also have a series of ETFs, right?
Yeah. Bitwise, we have a whole platform of different tickers that you can access and get exposure in your brokerage accounts, your IRAs. Advisors can place it into their portfolios for clients, so the clients don't have to go open up new accounts, attach their bank to it. So that was a smoother way to invest, as most people are already just comfortable with investing with different tickers.
And a lot of people thought this was a scary thing, and there's people saying it's going to zero and all that, but gold didn't go to zero either. So there's still opportunity. So you don't think it's going to zero?
I do not think it's going to zero. It's a $2 trillion asset today.
Right.
There's been some stats that there's never been a $2 trillion asset that's gone to zero in investment history. So definitely don't think it's going to zero. And I think we're still in early days, like we said a little bit ago.
Right. So there's lots of opportunity, and digital assets and the different ETFs that represent those digital assets are investments that individuals can participate in and then hedge their overall portfolios, even their bonds and their stocks over time as well.
Yep.
Adding this in could be a really nice thing to do.
Yeah, we're seeing people use it for a diversifier where it's not as correlated to stocks and bonds. Can't make any recommendations, but we're typically seeing somewhere in that 1 to 5% weighting in someone's portfolio. Makes a lot of sense.
Well,
Make a lot of sense.
And then all the Bitwise ETFs are available at FourStar. And so each individual investor should contact their FourStar advisor and see if any of this is right for them. But it's something worth looking at, I'd say.
Yeah, absolutely. We're happy to help out and glad to be here today.
Excellent. Well, good. All right. Well, thanks, Garrett, and thanks for being with us
Yeah,
here.
absolutely.
Interview series at our
Pleasure.
summer conference. Thanks
Yeah.
so much, sir. Thanks so much. Okay, welcome back again, everybody. We're continuing with our series, talking to sponsors who are down here at the FourStar Summer Conference in Acamal, Mexico, south of Playa del Carmen and the Riviera Maya. So we've had 100 advisors down, 100 advisors and staff and guests. And the gentleman who's with us today is one of our great sponsors, and his name is Pisoot. You have a very long last name, so I'm not going to get it right.
That's all right, Brad.
All right.
Thank you.
But Pisoot represents a company called Anchorado, and they're in the structured note business and manage structured notes for individual investors. So Pisoot, tell us, what is a structured note?
A structured note is a hybrid security that is a combination of basically a bond by an issuing bank that has derivatives wrapped on top of it, right?
Right.
So unlike a traditional bond that typically is just going to yield, call it 4 to 6% right now,
Okay.
a structured note that's income oriented could yield 12, 13, 14% right now from the same issuing bank. But because there's these options or derivatives that are wrapped around the bond, that's what's able to deliver that type of performance.
Okay.
Right. So the other person on the other side of the options is paying a premium if certain parameters are met.
Mhm.
But
Great.
they're very unique and compelling product to put in clients' portfolios right now.
So like if a bond you said pays 4 or 5%, structured notes are paying what, 10, 12?
Yeah, and depending on the structure of the notes and what you're using as the underlying assets, right? The underliers, as it's called, they can range from 6 to 9 on a more conservative side. They can range from 10 to 14 on a little more conservative, moderate. And if you really want to become aggressive and use individual equities and stocks as your underliers, you can get 20+% per year, per annum, right?
Wow.
And many of these are paying monthly. So you get a note that's paying you 24% coupon monthly. That's 2% per month.
Yes.
Obviously, they have some downside. Risk, but structured notes can also have some downside principal protection built into it. Yeah.
So there's all these features for each note. So they're somewhat complicated, actually, but you guys actually manage it for the investors.
That's right. We manage it really on behalf of the advisor, right? Because the way that we've structured our portfolios, they're each designed to accomplish a specific objective. So let's say you have a client and they are 55 years old, they're conservative to moderate risk tolerance, and they're looking to build up their current income so they can retire. Well, we have strategy. We have a conservative fixed income strategy that could be a great solution for that. It could be a great complement or a replacement to their traditional bond strategy. So we can essentially take a traditional fixed income strategy that's maybe generating 4 to 5%, and blend our strategy in with that to generate 10 and 12. Then now you have a combined rate of 7 to 9% for those clients.
Right.
Again, so it's accomplishing the objective without adding additional risk.
Yes. And this whole structured note area became a lot more interesting when interest rates went to zero for a long time, right? Then all people are like, there's no income. How are we going to have any income? And so structured notes became to the fore because they were still paying in the mid single digits at the time. Now they've gone up too, along with the bond market and interest rates, right? So that actually really helped the structured note market to get noticed, right?
Especially here in the U.S., the structured note market has been utilized globally since 1980s.
Okay, yeah.
Globally, it's a $3 trillion industry. But to your point, it really just started catching favor here in the U.S. a few years ago when interest rate environments were really low. And last year was a record-breaking year for the U.S. in terms of structured notes, with over $150 billion worth of notes sold here in this country. But when you compare that to the $3 trillion industry globally, we're still an emerging market, believe it or not.
Yes.
The U.S. is an emerging market when it comes to structured notes.
Structured notes, yeah.
Even with us, we saw a huge uptick from January to April of this year compared to last year. We saw a 54% increase in total notes that we purchased just in those 4 months compared to the same time period the year before.
Okay. Wow. That's really great. And so this program is a SMA program. It's separately managed accounts, right? So your advisor could say, I'm going to put 100,000 or 500,000 in structured notes, and then you guys take it away from there.
That's right.
And then you buy different. How many notes are in a portfolio?
Yeah. So typically, what we're doing is one of the first things we want to mitigate what's called overconcentration. Right. Whenever you Google structured notes, there's all these alerts that pop up about risks. And the first risk that pops up is typically overconcentration, meaning you're over allocating to one note.
Right.
So the way that we offset that is when we're buying notes into our particular strategies, we typically don't allocate more than 6% of any client's allocation to us, not the entire account value, just the portion to us. Yeah. We don't allocate more than 6%. So the average note we're buying is maybe 3 or 4% of the allocation.
Okay.
So in their portfolio with us, they'll own anywhere from 20 to 40 different positions over time.
So it's well diversified.
Very well diversified.
So if there was any trouble with one note, it wouldn't be as significant.
That's right.
Just like stocks go down too, right? So you have to diversify stocks. So diversification, folks, is always the key. And so now these programs, you have at least 4, right? Or there's even more now.
That's right.
Right.
So we started with 4, and then our first SMA that we started was our conservative income back in 2019. So we have a 6-year track record on it. It's been a very compelling track record.
Yeah.
But since then, we've also talked to a lot of advisors who are looking for even more conservative strategy. So this year, we've now launched 2 what we call conservative strategies called broad-based indices. And we're only using broad-based indices as the underliers. Okay. The reason why that's more conservative is because they have even less movement than even sector ETFs. Sure. So it's the outcome is much more predictable in those.
Great. So now FourStar advisors have access to all these programs.
That's right.
Right.
And Brad, I got to thank you. Obviously, we're just at $260 million of assets under management now. Starting this a few years ago here, FourStar has been a fantastic partner with us. We truly appreciate how you have brought us to your advisors, how you've allowed us the opportunity to have a voice with your advisors, and many of them taken towards it.
Yes.
And you guys have even created your own sort of UMA platform for your advisors, which I think is very unique in the marketplace.
To allow people to participate in these projects, right, in a very seamless way. Right. Well, great. Well, yes. So folks, Anchorado and all their programs are available on the FourStar platform. So contact your FourStar advisor and see whether this is the right thing for you. If you could fit that into your portfolio, it certainly makes sense to have a look, I think, for sure. Well, great. Well, Pisoot, this has been a great discussion. Thanks for being with us today.
It's always a pleasure.
Series at FourStar Summer Conference.
It's always a pleasure. And we thank you very much for being a partner with us.
Thanks, folks. We'll be right back with another interview just shortly.
Yeah.
Hey, welcome back, everybody. We're continuing with our interview series with our great sponsors here at the FourStar Summer Conference in Acapulco, Mexico. And right now we've got our good friend James Lee, and James is with PRP, Purified Resource Partners.
Yeah.
And you guys are in the oil business.
That's right.
Right. So is this oil drilling or how does this all work?
It is. This is a direct participation oil and gas drilling program that we designed for
investors to be able to directly access working interests in drilling projects in North Dakota and Montana. It's called the Bakken Shale.
The Bakken, okay.
Correct. And it's actually one of the most de-risked plays in the country. It's been around since the mid 2000s. Over 18,000 horizontal wells have been drilled here. So we have a pretty good idea of where to find the oil and how to produce it, how to develop it efficiently.
So you guys are an operating oil company.
We don't operate it. Our
No?
model
Okay.
is
You're
non-operating.
non-operating.
Correct.
Okay.
Yeah. And what that means is that we partner with larger operators.
Okay.
We own minority interests in drilling projects.
Okay.
And when they go to develop a well, they'll reach out to all of the minority owners in that drilling unit, and we get to participate alongside them.
Nice.
So we get to ride the coattails of much larger, much more capable companies than ours, and enjoy in the production that they are able to get out of the drill program.
So the investors get participation rights essentially, right? So
Exactly right. So
Okay.
the investors get direct participation rights. They own a piece of a portfolio of wells. We typically target 30 to 50 wells in each fund, so that we have sufficient diversification,
right?
and you reduce any type of single well event risk. And in addition to the actual production and cash flows that you get from the wells, you also get pretty significant tax benefits with our program.
So how does that work? What kind of tax benefits?
So the government is really trying to incentivize continued development of this critical resource, oil and gas. And so what that means is that they give us the ability to take 100% deduction on the majority of your drilling costs. They're called intangible drilling costs. And in the year that you drill the well, that those costs are incurred, you get 100% deduction on that against your taxes.
Nice.
The other components of the drilling and completion costs get amortized over a 7-year period, but you basically get to write off the entire investment, majority of it up front. So what that means is for every dollar that you invest, about 70 cents in the first year will be deductible. And
Okay.
so if you're in that top tax bracket, which a lot of your audience may be, that would mean about a 25% tax savings in
Okay.
that first year.
So people can invest and then they get tax breaks depending on their tax position, right?
Right.
And then do we get income as well?
We do. This is an income focused structure. The tax benefits are nice, but the real focus of this is to provide high quality drilling opportunities that will hopefully, based on our underwriting, try to double your money for each dollar that you put into the ground.
Okay.
And that capital gets returned to you in the form of quarterly distributions.
Okay.
Because of the wells are very prolific early in the life of the well. So your early life distributions are going to be pretty significant.
So big. Okay.
So we target 100% return of capital on a deal by deal basis within 2 years. On a portfolio basis in 3 to 4 years.
So then what happens? How do we end the investment? Do we sell it or what happens?
Yeah. So we would look at monetization events, selling the residual cash flow stream. The markets have to cooperate for that, of course. Commodity price markets and the strategic buyers that could be there, willing to pay us a reasonable valuation for it. In the event that market isn't open for whatever reason, then we can continue to distribute those cash flows on a quarterly basis.
Okay.
Until the market's right.
So the market's right.
Correct.
So oil prices have been pretty volatile. Now we have wars going on and things like that. So oil's going up a little bit
Sure.
again, right?
Yep.
What do you think about oil? I mean, could they go down a lot or?
Commodity prices are volatile, of course. They will always move up and down. One thing we do underwrite to kind of flat price decks, but they never seem to be correct. The sad reality is when there is geopolitical conflict in the world, particularly in oil producing areas like the Middle East, then that will result in higher oil prices. There is also, kind of supply demand fundamentals that will dictate the direction of oil and gas over the near term at least. But what we try to do is be very adaptive and reactive to fluctuations in commodity prices. So what that means is we will either slow down or increase the pace of activity. In lower price environments, you also get your drilling and completion costs reacting to that lower price environment. So that means you can get into deals for cheaper and you can drill and complete the wells cheaper.
Yeah.
So that helps to create a little bit of a shock absorber for our drilling projects.
Sure. Okay, great. So now, folks can invest, is there a minimum?
There's $100,000 minimum.
$100,000
We are looking to bring in accredited investors into our fund. And we are marketing exclusively to RIAs and fiduciaries. And we designed this program specifically to be aligned with our investors.
Great. And FourStar is an RIA firm, so every client has an advisor at FourStar, and you can talk to your FourStar advisor to see if this is right to add to a portfolio of different alternative investments for you. And it's a seated member of our platform, isn't it?
It certainly is. And
Right.
we're proud to be a member of your fund, and we look forward to developing a partnership with you. Our intent here is really to have this programmatic investing, where you have the opportunity to invest in fund year after year.
Year after year.
And then you get the distributions from the earlier funds that are helping to fund the investments in people.
Right. So you keep like a stable amount in that segment, you get the good returns.
And you get the tax benefits each time you invest.
That could be a great idea. Yeah, that's great.
That allows you to compound on your own. We don't do the compounding for you. We put that reinvestment decision back in the hands of advisors and their
Right.
clients.
Right.
And in certain years, when you have a big capital gain event, or you get a big bonus or something, you get some additional tax shield.
Yeah.
We have the ability to calibrate that on a year-by-year basis.
Nice. So it certainly sounds interesting. And folks, if you're interested in learning about these oil programs, again, talk to your FourStar advisor. And these are all available. This program and some others in the oil as well on our platform. So James, this has been a great discussion. Thanks for joining us here on the interview series.
Thanks
and
for
thanks for
having us.
being down here in Mexico.
It's our pleasure.
All right. Thanks, everybody. We'll be back with another interview in just a second. Well, hey, folks, we're back on our interview series here at the FourStar conference. And gentleman to my left, looks like right on the screen. To my left is Chris Wise. And Chris is with Wise Capital. And where are you guys? In Louisville?
Louisville, Kentucky.
Louisville, Kentucky. Great. Now, these guys also operate in the multifamily space, but you're specifically finding properties that need an upgrade, right?
Right.
It's like there's like A, B, and C. So you're looking at C's to make them B's.
Yeah.
Tell us about that, Chris.
Yeah. So the Midwest market is about 38% of Class C, 40% B. And the fundamental factor in determining whether a property is A, B, or C is the year that it was built. So follow the logic, then you'll find that, in the next 5 years, the dominant class should be Class C, just because as these properties that are Class B, they age, they'll convert over to C just naturally.
Yeah. Well, it's funny, as you grow older, you realize, that apartment complex was just built a few years ago. You realize it's been 25 or 30 years. They're probably C's by now.
Yeah.
And they need an upgrade.
Right.
Right. And that's what you guys are trying to do.
That's right.
And if nobody upgrades it, they got to tear them down.
Yeah.
That's right. Yeah. Anyway, well, good. So then, how does this all work? So you guys raise capital from investors, and then how long does it take to redo these properties?
So typically it's a 4 to 6 month window on the renovations. We're very strategic about what renovations we do. So a lot of these Class C properties, they're not falling apart. And so, we always say we look for the Class A and Class C. They're, well-designed, great location, occupancy tends to be over 95% in the Class C market. Rent growth around the 3.5% annual rent growth range there. National range about 0.9, just for comparison. And what we do is we evaluate the property. We evaluate about 200 properties a week. Using our technology and software, we then limit that down to about 5 properties that we're looking to reach out to an LOI, get more information. And then from there, we create a strategic plan on what renovations actually need to take place. That's actually going to give us an ROI on the investment into that property.
Okay, that's a big word for return on investment.
Yes.
Okay, yeah, exactly. Okay, great. And so 4 to 6 months ramp up time, and then so now how do investors participate in something like this?
Yeah, so they can participate directly or through their advisor, and really what we're looking for is accredited investors. Minimum is a $50,000 investment.
Okay.
Our fund is a $50 million fund. And what we're looking for, again, in the Class C range, tends to be between the $3 and $6 million mark on Class C property.
Yeah.
That tends to put us in between the 50 and 75 unit count on average. Some are more than that, and some are about 32, 34, depending on the location and what we're looking for.
Okay, great. So then what's the minimum investment?
50,000.
50,000. Okay. So, and it's part of a partnership, like an LP or a
We're an LLC.
LLC.
It matters, but it's similar structure.
Okay.
Yeah.
All right. And so folks can add your program in as part of a portfolio of different investments to diversify and everything. And then how diversified is your program? You put 50,000, like how many different complexes?
So this first fund should sit around 16 to 18 properties. You're not investing in one property.
Oh,
You're investing
okay.
in the fund, which will collect the 16 to 18 properties that we're looking for.
So in this fund, how much are you trying to raise overall?
50 million.
Oh, 50 million. Okay. And that'll buy you, you said 16 to 18 different
Yes.
programs. Okay, great. Great. So folks, this program is available on the FourStar platform. You should check with your financial advisor. We got some rock music here.
we do.
At the pool helping us out here. Sorry, I hope you can still hear us, everybody. Yeah, so this is available on the FourStar platform, and it's a different twist on the multifamily investing where we're trying to take older quality properties that need a facelift and make it better, and then get better, as he says, ROI, return on investment. And so, the world is pretty underserved as far as like units, right? There's 5 or 6 million housing units in America that still need to be built, right?
Yeah.
There's a lot more. So this is a great service and certainly a well needed thing for America as well. So
Yeah, we're focused on working class, families. And so when you look at Class A rent, some of the 2-bed, 1-baths and Class A luxury, especially, I mean, those are going for $2,600 a month. And
yeah,
a lot of working class families can't afford that.
can't afford that.
They want to stay in the location. They like the area, and they need something. And
Yeah.
what we're doing is implementing our technology as a property tech company to improve the quality of life. And so that's really what we're focused on, aside from just the routine renovations, dog parks and playgrounds and upgrading maybe some amenities and, floors, kitchens, that kind of thing.
Nice place to live.
Right.
Yeah, that's great. Well, great. Well, this has been a great discussion. Thank you for being with us today, Chris Wise, on the FourStar interview series here at the FourStar Summer Conference. We'll be back again, folks, in a minute with another interview. We'll talk to some more great sponsors. Hey, everybody, it's Brian Castle again here, back at the sponsor interview series here at the FourStar Conference down here in Acamal, Mexico. And our new sponsor who's taken the chair is a good friend of mine, is Dan McDermott. And Dan, you're with Smart Cap Partners, right?
Yep, that's correct.
And what your strategies are tax-oriented real estate programs. And we're going to hear about that, the ways to invest in real estate programs that offer you some unique tax benefits. So tell us about the first one. It's historic properties,
Mhm.
right? Okay.
Absolutely.
Let's hear about historic properties.
Yes, absolutely. Thanks for having us. The certified historic properties are a little known part of the tax code that allows investors to utilize historic properties and claim a deduction against their lost development potential.
Okay.
So what does that really mean? That means, let's say you have a property that downtown area, it's a historic property from the early 1900s. Potentially what you could do is you could knock that property down and you build a brand new Class A multifamily, stabilize that and generate income.
Okay.
The part of the tax code with this incentivizes developers to willingly conserve that property
Okay.
in lieu of developing it.
Okay.
And for doing that, what they do is they allow the investors or the developers to take a deduction against your lost development.
Okay.
That can be pretty substantial.
So-
Up to 50%.
So, okay. So 50% of your adjustable gross.
Mhm.
And then what is you put 100,000, what would be the normal deduction roughly?
Yeah, roughly. Yep. So what these are is generally the normal deduction is a 2.5 to 1. So what it means is if you were to put $100,000 in, you would receive a $250,000 deduction that you could use up to 50% of your adjusted gross income. So
Okay.
again, just a quick reminder, adjusted gross income is all your forms of income. That's your capital gains, ordinary income,
Right. Okay.
portfolio and dividend income as well.
Adjustable gross income.
Mhm.
Okay, good.
Yep.
All right. And then you own the property long term as well, right? You get good returns on it.
Yep.
And then the tax breaks help you. And then of course, then you have a property investment, which you could make good money in.
Yep,
I haven't
absolutely.
really checked out what that's going to be, but hopefully it's good.
Yep.
And then these properties have grown an average of 6% and leverage is a little bit more.
Yep.
So we hope that's kind of like what happens.
Yep, absolutely. Yeah. So it's really a traditional true real estate play. As you said, the tax benefits come on the front end. Additionally, all the investors that invest in the deal have the luxury of generating NOI from that property that can be distributed out to the investors. That distribution goes out to investors. Additionally, at year 6, the properties can be liquidated. And if they're liquidated and held for over 6 years, they will not be subject to depreciation recapture, which is attractive for a lot of investors.
Well, Dan, we've got some revelers at the pool and some rock music here to join us as well. So hope you can still hear us, folks. All right. So that's number 1. Number 2 are the fee simple real estate programs, right? So let's talk about that.
Yeah, absolutely. So this is a part of the tax code called 170A. And what it does is, again, it incentivizes developers to conserve property in lieu of developing it. These are green space easements, meaning that they are raw natural land that a sponsor is deciding to provide 3 options for investors. What they do is they can either hold the property for investment, they can opt to mine the property, since these are mining opportunities, or they can opt to donate the property.
Okay.
Donate the property. Generally, those donations range in the 4 to 5 multiple range, meaning that if you put 100,000 in, potentially you could get anywhere between a $400,000 and a $500,000 reduction.
All right.
You could use up to 30% of your adjustment.
30% of adjustment.
Yes.
Okay. Great.
Yep.
So these are programs that offer significant tax advantages. And why do they offer these? Why does the government allow this?
Yeah, with most things, they're trying to incentivize behavior. And really with these, it's the government's was pretty worried about over development of 1, raw natural land, and 2, development of certified historic properties. So really 2-factor. 1, you're doing well for the environment. If they conserve property, it's for everyone's public benefit. Additionally, our history is very important in our country. You know, historic buildings in Chicago. Some of those can be conserved, as well as other properties throughout the United States.
Nice. Great. And so SmartCap has other programs too. And we'll hear about those probably in another show.
Yep, absolutely.
All right. Well, great. So these are all available on the FourStar platform. And so it's important to talk to your financial advisor and then do the math and figure out what makes sense for you as an investor and how much money you are comfortable investing in these kind of programs. But they could be significant benefits to all investors if you choose to do it. So again, this is not an offer to buy or sell, but talk to your advisor and see if it makes sense for you.
Absolutely.
Well, thanks, Dan. Thanks for being with us today.
Sounds good.
It's certainly been great to have you here on the FourStar interview series. We'll be back again, folks, in a minute with another great interview. Be right back. Okay, everybody. Well, thanks. That's our episode for today. We just wanted to do some interviews so folks could see some of the new products and services that are being offered through FourStar Advisors. We'll be back again shortly with another podcast episode talking about the markets and all the great things that we need to worry about to help serve our clients. So we'll be back again. This is FourStar's Today's Market Explained for this episode. Over and out. We'll see you next time.